Yo, what's up everybody, and welcome back to the channel. Today we're doing a full breakdown of my stock portfolio performance over the last month, from the beginning of January right up until now, early February 2026. I'm going to walk you through exactly what happened, the moves I made, and why I made them. We're starting with a quick recap of the positions I closed out since the last update, and the returns I locked in on those. Then I'll show you the new stocks I added to replace them, and explain how they fit perfectly into my long-term investing thesis. After that, we'll talk about the bigger picture, why software stocks and big tech got absolutely crushed this month because of all the AI hype, fears of overspending, and the so-called SaaS apocalypse. And finally, I'll wrap it up with the portfolio where it sits today and what I'm thinking moving forward. First up, the closed positions. Since early January, I exited 3 names: Costco, Hasbro, and S&P Global. These were solid holds that performed well while I owned them, but the valuations got so high that I felt more comfortable selling and rotating the capital to other companies with better valuations that still align with the thesis. Here's the return on investment that I locked in on those positions. Costco, 12.3%. Hasbro, 9.9%. S&P Global, 8.1%. These 3 companies and their fundamentals are still fantastic. The decision to rotate the capital into other companies was purely based on valuations. Now let's talk about the new additions that came in to replace them. We have Salesforce, Visa, and Duolingo. Along with adding these 3 positions, I also added capital to the positions I already had, especially Netflix and Microsoft, with Microsoft becoming by far my largest holding, nearing the max 30% I can have for one position. And since there were so many good buying opportunities, my capital in this portfolio is nearly 100% invested, reaching a total of $44,718. Now, I'll go over the new positions and how they fit the portfolio. First, I'll go over Salesforce, a leader in enterprise cloud CRM software. The revenue growth is consistently in the high single digits to teens, with accelerating profitability. The debt-to-equity ratio is well under 1.0. And they have a massive, durable moat from deep integration into customer workflows, huge switching costs, and now layering on AI capabilities. The global enterprise customer base gives nice revenue diversity. Second, we have Visa. The top and bottom line growth is usually in the high single digits to low double digits. The debt to equity is extremely low, often near zero net debt. The moat is one of the strongest in the world. Network effects that get more valuable every year, geographic diversity across basically every major market, and no credit risk since they don't issue cards or lend money themselves. And last, we have the new wildcard, Duolingo, which is a consumer language learning app with a subscription model. Revenue is growing about 40% year over year and profitability ramping fast. The debt to equity is basically zero, and the moat comes from habit-forming gamification, massive user data flywheel, and first-mover advantage in the app-based education space. While smaller than the others, the growth profile and the balance sheet fit the thesis perfectly. These companies fit right in alongside Microsoft, Amazon, Google, and Netflix. They are all high-quality platforms with recurring revenue, scalable economics, strong balance sheets, and real competitive advantages. Now, let's address the elephant in the room. Why does the portfolio show a 5.61% loss? January into early February 2026 was brutal for software and big tech. A ton of fear around AI swept through the market. Worries that new generative AI tools from companies like Anthropic could automate away traditional software jobs, undercut software as a service spending, and disrupt established business models. On top of that, the hyperscalers like Microsoft, Amazon, Google, and Meta dropped massive capex bombs, projections for hundreds of billions in AI infrastructure spending in 2026, which had investors questioning if it's sustainable or just an overhyped bubble eating into returns. Software stocks got hammered, but I actually see this as a healthy shakeout. The fundamentals of these companies have not changed. They still have durable moats, growing revenue, clean balance sheets, and huge long-term runways in cloud, digital advertising, subscriptions, and payments. So for now, We have a total portfolio value of about $44,718, offering a 0.36% dividend yield. I'm very bullish on this basket of stocks long term. These are the kind of businesses that tend to come out stronger after periods of fear and valuation resets. Alright, everybody. If you're still here, go ahead and smash the like button. Drop a comment telling me what moves you're making in this market, and subscribe for more. Thanks for watching, and I'll see you in the next one.